Hello, I'm Bernard Hickey from interest.co.nz and welcome to another double shot interview. And this is our weekly Never a Dull Moment report on currencies with Dan Bell from HiFX. Welcome back, Dan.
Thanks.
Never a dull moment again this week.
Never a dull moment in the currencies, yeah.
Yes, with the New Zealand dollar up to yet more record highs, over 86 US cents. How high can it go?
That is the question on everyone's lips at the moment. We got to an interbank high in the last 24 hours of around 86.40, so extremely strong. We've seen, obviously, the Europeans come out with another bailout for Greece overnight, and essentially they're pulling out all stops. And the underlying sentiment of what they're doing, I think, is to say, listen, we're going to do everything that we possibly can to make sure that this European debt crisis gets sorted, at least in the short term. So risk on for currencies, the New Zealand dollar up, the Aussie dollar up, the euro up, and the US dollar under broad pressure.
So what do the charts say about how high could it go?
The technical target that we've had on the charts has been 90 cents for a little while. So we've seen it make that 85 cents was the initial target, and you had quite a few of the local forecasters talking about 85. Obviously we're well over that level now, and really you have to go well back, over 30 years to pre-float days to get any kind of guide as to how far the New Zealand dollar can go. But I mean, at over 86, I mean, to see it up another 300 or 400 basis points is probably not too much to ask, given how strong it has been recently. So 90 cents is probably a realistic target.
And against the other currencies, it has been relatively strong against the Australian dollar, but maybe not in the last 24 hours or so.
Yeah, that's right. We pushed up to a high just around 80 cents against the Aussie dollar. So, we have been a lot stronger against the Aussie. Against the euro, we were up over 60.5. Against the pound, another post-float high over 0.53. But we are actually a little bit weaker this morning. We've seen the Kiwi back under 60 against the euro, back under 53 against the pound, and back in the low 79s against the Aussie dollar. So maybe a little bit of profit taking in the Kiwi. I mean, we've been one of the best performing currencies for a while now, so we are seeing a little bit of weakness there.
Why do they love us so much?
Well, I think it's you've still got the global economy awash with cash, so to speak. The US have been on their money printing exercise for the last couple of years. Other global central banks have had other forms of quantitative easing or money printing, low interest rates, and the money has to go somewhere. So I suppose the New Zealand dollar relative to a lot of other economies is still quite attractive.
Now, just looking at these overseas factors, firstly, the European debt crisis. We saw the crisis meetings on Thursday, and a deal seems to have been hammered out. Let's find out more about that deal. Looks like they've come up with a new, bigger, stronger fund to bail out the pigs.
Yeah. Pretty much, yeah. I mean, they've come out with this emergency fund. They're talking about giving Greece another 109 billion euros, as well as some participation from the private sector. So the private sector are also looking, or have essentially agreed, in theory, to take a haircut on some of the Greek bonds that they've got in their own balance sheets. So.
Not so worried about default anymore. There was a lot of talk a couple of weeks ago, never a default. Now they're saying, well, selective default's okay.
I find it very interesting. I mean, the first thing that I asked this morning when I got into the office was, okay, so essentially this is a soft default, right? No comments from the credit rating agencies. I did read one report which indicated that ISDA, who the Institutional Swaps and Derivatives Association, who make a judgment about when a credit event occurs on the credit default swaps, apparently they had been asked, and they had given it the all clear at this stage. So
those are the things to watch: whether it's declared a default and whether the ratings agencies also decide whether it's a default.
Yeah, I mean, it's really kind of, you almost wonder if there's been some political pressure on the credit rating agencies, what's going on in the background. It's hard to say because, it only seemed like the other day that you had all the credit rating agencies, coming out making calls about, the potential default in Greece and elsewhere. So
that was this week's bailout plan. We seem to have had a few of these things. Has this really sold it for forever, or are we going to come back to this again?
No, I don't think this is it. I think this is again another, as the popular sort of, kicking the can down the road, so to speak. So I mean, this is a great confidence builder in the short term, and I think if you look at how things are sort of playing out in the global economy, things are still very fragile. There's still a lot of issues to get through. What we don't need is a lack of confidence in businesses and households. And I think what we're looking at from the EU overnight, and probably what we need from the United States in the next week or so, is some kind of confidence that they are going to provide some short-term relief. And hopefully, hopefully the economies can pick up.
And across the Atlantic to their debt crisis there, where the Republicans and the Democrats are still in dispute about what type of deficit reduction plan they're going to have and whether they can raise this debt ceiling. How closely are markets starting to watch this situation?
Oh, very, very close. And there has been news this week that they are getting closer to some type of deal that's going to be sorted before the 2nd of August deadline. So markets are feeling a little bit more confident that that's going to be finalised. Otherwise, obviously, the ramifications are that there is potential for the US to default. It is still considered a very, very low probability, but it still needs to be considered. So,
what happens to the Kiwi dollar if the US does default August the 2nd?
The US defaults August the 2nd. I think you see a risk-off event. You see the equity markets would come under significant pressure. You would see commodity prices weaker, and I think you would have to see the New Zealand dollar weaker as well. I mean, ironically, you'd probably see the flight to safety benefit the US dollar and benefit US Treasuries, which seems ironic, but the reality is no other economy or currency has the liquidity or the depth to handle the kind of flows that large pension funds and central banks need to put their money into.
Now, there's also fresh talk about a double dip recession in the United States, and renewed talk about quantitative easing 3, a third round of money printing. How's that shaping up?
Yeah, I think you've got more analysts out of Wall Street talking about the potential for a double dip. But if you go back, 3-4 months ago, a lot of those same analysts were quite upbeat about the outlook for the global economy. So we're kind of swinging between this really, overly bullish and overly bearish kind of mentality in the market. And I think it's part of this sort of crisis mentality that we're all kind of dealing with at the moment. There seems to be a new crisis every day, and part of that is that on one hand things seem to be getting sorted in the short term, and then another crisis comes on, and there's a lot of negative sentiment associated with that. I'm in the camp that I think I don't think we're going to see a double dip out of the United States. I don't think we're going to see huge growth out of the States, but if you look at the kind of levels that we're coming off, it doesn't actually take much to see a little bit of growth from the States, considering we're coming off some very, very low levels.
And the one area in the world that is growing still is China, although we've seen some signs this week that output may be coming off the boil there.
Yeah, I mean, some of the recent data out of China has been weaker than expected. Again, they had another PMI number which was weaker than expected this week. But if you go back to last week, their industrial production and GDP numbers were actually stronger than expected. So as much as China is certainly a concern, I don't think we're seeing enough weakness there to justify a bearish outlook for China at this stage.
Getting back to Australia, we've seen minutes from the Reserve Bank of Australia this week, and next week we have inflation figures. What's the outlook there for interest rates and the currency?
Yeah, so the RBA minutes released this week basically said that they're going to be watching the data to see where inflation goes, and the CPI number on Wednesday next week is going to be key. So a few weeks ago we had the market pricing and rate hikes from the RBA. Last week you've got the market pricing and rate cuts from the RBA. So it's quite an interesting outlook for Australian monetary policy.
So we'll keep an eye on those inflation figures next Wednesday. And then on Thursday we've got the Reserve Bank of New Zealand with its regular interest rates announcement. What are people expecting?
So we're not expecting any change to the OCR next Thursday. So leave the OCR at 2.5%, but I think the expectation is he's going to start talking up earlier rate hikes, and the market obviously bringing forward expectations of the first rate hike from what was initially sort of December or early next year to as early as September this year. So a lot of the local banks and economists are calling for a first rate hike in September, and potentially further rate hikes from there on in.
Will Bollard comment on the currencies?
I think he has to. There is no doubt that the New Zealand dollar is on everyone's minds at the moment, trading over 86 cents. It is going to be a huge issue for any manufacturing exporter exposed to that. Who isn't getting the prices that the commodity exporters are. So it has to be mentioned, and I think it is going to be doing some of the tightening for him, particularly on the productive side of the economy.
Because the last time the trade-weighted index was up near these levels, although it was up at 77, it's currently around about 73, 74, that's when the Reserve Bank intervened. There's no suggestion at the moment they're going to intervene, or any signs of it?
No, there's not, and they certainly haven't made any comments to that extent. The last time they intervened in 2007, the trade-weighted index was around 77, we're around 74. I think if you saw the markets get to the point where the appreciation of the New Zealand dollar got disorderly, i.e. it just kept on going up and we didn't see any kind of corrections or pullbacks, that's when I think they would get concerned and maybe look at intervention on more of a smoothing sort of basis, trying to actually level it out rather than make some kind of change to the overall trend or direction, because I don't think we've got the RBNZ doesn't have the firepower to change the underlying trend in the long run. But other people have different opinions about that.
There we have it, another week of turmoil on international financial markets. Plenty to keep us busy, never a dull moment. Thank you very much, Dan Bell from HighFX. I'm Bernard Hickey from interest.co.nz. That was another of our double shot interviews.